Marc, I'll start from ADM Investor Services International with some thoughts this week on what I would call dissonance, above all in US jobs data, and dissonance indeed in the way that US financial markets are performing. So let's start off with the US NFIB survey. We had that yesterday, and I think really the standout element in it, and so you can see in my first chart, is how pessimistic small business owners are in the US relative to how big business, which is represented on this chart by the NY Fed business leaders' expectations, which with expectations soaring, while the NFIB measure plummets to yet another low in this particular cycle. It had remained quite surprisingly buoyant last year, probably quite well worth noting. But clearly there's some disconnect there between the two. My second chart is in the same vein to show that the JOLTS job openings, this is the amount of unfilled positions, has soared to yet another high. It rose by yet another 100, almost 1 million last month, having had a sturdy rise of 500,000 the previous month. So there are plenty of job openings around. And indeed, on my third chart, which is the US JOLTS quit rate, which is the rate at which employees are quitting their jobs for another one, versus the NFIB's jobs hard to fill rate, you can certainly see that the labor market seems to be very buoyant, despite the fact that if you look at it in pure unemployment terms, we've still got a lot of labor market slack, with still a lot of people claiming benefits. So that's certainly very optimistic, but I think it tells us also that there's a clear amount of a very clear amount of skill shortages showing up somewhere, which may be down to a couple of factors. First of all, people changing their attitudes to work, how they engage with the workplace, employers perhaps not being quite so adaptable in terms of flexibility, which people have become used to during the pandemic. But it certainly tells us this is a labor market somewhat in flux. And getting to the Fed's target on the labor market may actually be more difficult than the Fed thinks because of a number of different factors. We may, in fact, also be looking for different types of job skill. So my fourth chart today is to take it into the market area. And that's also it's basically to highlight that as much as inflation is going up with the projections for tomorrow's CPI data, looking for another sharp rise to 3.4%, that would be the sort of highest levels that we've seen since the early 90s. But meanwhile, 5-year break-even inflation rates have over the past couple of months, suggesting that markets don't believe that this is actually going to be runaway inflation. Perhaps enlightened self-interest because they just want to buy into the Fed's mantra, and also perhaps an element of not jumping the gun because the Fed isn't going to jump the gun. That doesn't mean necessarily that the Fed will at some stage be forced into a retreat. My fifth chart is VIX volatility versus move volatility. That also underpins markets. It underlines there's a lack of volatility around, and that encourages risk-taking without a shadow of a doubt. My sixth chart is the US 10-year yield, which I think in a certain sense is remarkable for the fact that, as one can see, it's actually gone into a downtrend now, which most people wouldn't have been expecting when we've got that rise in US inflation, and some concerns there, and above all, expectations that the economy is going to strong recovery. Which brings me to my seventh and final chart for today, which is the US Fed funds rate, effective Fed funds rate versus the overnight reverse repo rate. And that is basically showing that there's a bit of a collateral shortage given the downward pressure on yields that we've got. And those are the thoughts for this week.